With this simple strategy, I have generated over 5 grand last month, and I'm going to show you what this strategy is and how to trade it. This strategy is called ICT Unicorn model. So basically there are 5 major components of it. Before trading it, you need to meet these 5 conditions in order to be profitable. The first one is session. My favorite session, I'm going to talk about that. Daily bias, the direction of the market, displacement, and breaker block. The last one is FVG aligned with breaker block. So what are these components? I'm gonna go through each one of them separately with clear examples. Okay, let's talk about session. What would be the best session? So the best session is New York session, kill zone, from 7 a.m. to 10 a.m. Pacific time. I mean, I have traded London session too, but my most favorite is definitely New York session. So this is obviously one of the best high volume session, and there is no any doubt about that. So second major component is daily bias. So through daily bias, you come to know the trend of the market. The market is bullish, bearish, based on your daily bias analysis. So basically there are 2 types of liquidity. So if you want to know the trajectory of the market, you need to understand liquidity levels. We got external range liquidity and internal range liquidity. So external range liquidity, also known as previous day low, previous day high, and internal range liquidity, also known as fair value gap. We're gonna hop over each one of them separately with few examples to clarify this concept. So previous day high. So previous day high and previous day low are the liquidity levels that can be used as a draw on liquidity or frame a reversal or continuation. So we have previous day low, previous day high. So basically we have 2 liquidity pool, previous day low, previous day high. So most likely the price is moving up to grab liquidity, the previous day high, and then may reverse or consolidate or maybe manipulate, and then there will be expansion. So now as an extension of this example, we have, in this example, we have previous day low, previous day high, 2 liquidity, external liquidity zone. So the second candle is traded higher, and the third candle is taking the previous day high, or maybe it is consolidating and then moving upwards. So, and there is another example for the bearish. So we have previous day high and previous day low. Most likely this candle is trading lower to grab previous day low. And then as the extension of this example, we have the same previous day high, previous day low, and then this candle is trading lower to grab the previous day low. As it has grabbed, and then it may reverse or may continue. It depends. The second liquidity is internal range liquidity, also known as FVG. So basically it refers to an imbalance in price action or a price vacuum caused by imbalance, where the market is likely to come back and rebalance before continuing higher or lower. So in bullish trend, the price is extending and there is consolidation, and by this extension we have 3 candles, 1, 2, and 3. So there is gap between candle 1 and candle 3. So this gap is called fair value gap or a vacuum, price vacuum. So there is chance that the price is trading back, tapping the FVG, and reverses, goes to its original movement, which is bullish. And in bearish trend, we have prices expanding, consolidating, tapping into fair value gap, and then it reverses. Serious vacuum between first candle and third candle. So this is basically a liquidity pool. Also here, this is a liquidity zone or pool. As soon as it grabs the liquidity and it is moving to its original trajectory. And the third major component is displacement. So what is displacement? A strong impulsive price move in one direction that clearly shifts market structure. So there are 4 characteristics of displacement. Displacement should have the following characteristics in order to be confirmed that that is displacement. Otherwise, we don't consider that as a displacement. First one, large candle body. Second one, high momentum. Third one is high volume. And the fourth one should break a key level, key support or resistance level. Let's have a look at this example, the first one. So here we have a new swing low and the price is reversing and there is a displacement through this key level, which is resistance. So it is breaking this resistance through these large bodies. As you can see here, it is not just a regular body of the candles, but it is the large bodies. So there is high volume, high momentum, and it is breaking this key level. It is breaking this key level. That's why we call it displacement from point A to point B. So this new swing, the price reverses from this pivotal point and it is breaking up this key level, this resistance level. So it is trading higher high, breaking this key level. So this from point A to point B, this movement is called displacement, which has high volume, high momentum, and breaking a key level. Here is another example for bearish market. We have higher high, higher low, higher high. So here we have a swing point. The market reverses, breaking this key level, this support level, and creating lower low. So here it has high volume, high momentum, large body. So it is confirmed that this is displacement. So it is also breaking a key level. Don't forget that one. Here is another example. The market is trading higher high, higher low, higher high. So from point A to point B, there is strong move of the price. So it is trading lower low. So here we have lower low breaking this key level. Breaking this key level, so it is basically called displacement. So these all 4 characteristics we can find. So the fourth major component of ICT Unicorn model is breaker block. So breaker block, it is referring to leg up, I'm going to show you through drawing and then later I'm going to show you on the charts too. Leg up before leg down that grabs the liquidity and displacement. So here from this point to this point, it is called breaker block. So this lower low grabs the previous low's liquidity. It is in bullish sense. So quite the opposite is the bearish sense. We have created a higher high, leg down before leg up that grabs the previous high's liquidity and then displacement through this breaker block. So here it is called breaker block. So this high took the previous high liquidity. However, there are some key conditions to confirm a breaker block is created. So what is the first condition? So the first condition is liquidity sweep, as I have shown in that simple drawing too. So the price is trading lower low, lower high, and then it is trading lower low. So basically this swing low is taking the previous low's liquidity. So it is liquidity sweep. So this is condition number one, which is met. And let me show you another example. So we have the price is trading higher high, higher low, higher high, displacement. So this higher high took the previous high liquidity. So basically it is liquidity sweep. So this high took the previous high liquidity, and then as soon as it grabs the liquidity, there is reversal. And what is the second condition? The second condition, the order block should be broken, either move above or move below. Above in bearish trend, and below in bullish trend. So order block, what is order block? The last bullish candle before the bearish move. It is called order block, which is generated. It means it is confirmed. It should be confirmed that there is order block. So in bullish sense, we have another order block. So we say the last bearish candle before the first bullish candle. So it is called order block. So what is it? It is the last bullish candle before bearish move, the last bullish candle before this bearish move, or it is the last bearish move before bullish candle. So this is candle number one, which was the last bearish candle, and this is candle number two. So it is breaking this order block. You know what I mean? And what is the third condition? So the price is trading lower low, lower high, lower low, and then the market is shifting its structure into higher high. There is not further lower low. So this is a key level that this displacement broke this key level. So when it breaks the key level, so that is creating a market structure shift. So let's have a look example for the bearish. The price is trading higher high, higher low, higher high, and there is displacement through this breaker block. Let me show you where the breaker block is, if you can tell me where it is. So the breaker block is here. So this is our breaker block. So the price is creating this higher high, and there is displacement through the breaker block, and also there is FVG too. I mean, FVG is aligned with this one. Okay, we're gonna talk about that later. So here the price is displacing through the breaker block, so there is basically market structure shift. So it is breaking this key level and it is trading lower. So the third condition is also met. So there should be three conditions in order to form a breaker block. So here are some examples of the breaker block. So we have the leg down before the leg up that took the previous highest liquidity, and there is displacement which creates market structure shift. So here is our we have our order block 2. This is our order block. Let me show you. Yeah, this is our order block. So it is breaking the order block. So what is this? This is our order block. So it is the price is displacing through the order block and as well as breaker block. So all three conditions are met. So this is called breaker block, which is the price is creating a market shift through this breaker block. This high is taking the liquidity. This high is taking the liquidity of the previous high. And as well as it is displacing through the breaker block. So it is confirmed that we have our breaker block in bearish trend. And let's talk about this bullish one. Price is trading lower low, lower high, and then lower low. Now there is displacement through this key level, which is creating a market shift. So we got market structure shift. So we have market structure shift in this level. So the price is breaking through this key level, and as well as it is breaking the order block, and we use our order block. If you can show me, our order block is this guy. Let me grab this. This is our order block. So it is breaking the order block, displacing through this key level, creating market structure shift. So it means it is being confirmed that this is our breaker block, as I have highlighted. So the last one is FVG aligned with breaker block. So this is another major component of our strategy, ICT Unicorn. So the FVG should be aligned or overlapping with breaker block in order to confirm that it is unicorn. So FVG, it is a price vacuum caused by imbalance. Where the market is likely to come back, tap into this internal range liquidity, and then reverse. So basically the price is filling the gap, or we say balancing the imbalance. It is in bearish sense, and in bullish case, we have candle 1, 2, and 3. So there is gap between candle 1 and candle 3. The price is expanding, consolidating, trades lowers, tap into FVG, and moves into original trend, which was bullish. So now we want to know what FVG alignment with breaker block is now. So we know in this example we have FVG, there is gap between candle 1 and candle 3, and there is breaker block, this one that I have shown in previous examples too. So basically the breaker block and FVG, they are overlapping. It is on top of each other. So it confirms that it is our unicorn model. It was the last condition basically. And now here is another example. the price is trading lower low, and now it is displacing through this breaker block, the leg up before the leg down that took the liquidity of previous low. So it is our breaker block. We resolve our FVG. FVG is one FVG we have here, another FVG we have here. Here are some of the live trades that I have taken in profit. So if it was helpful, please comment, like, and subscribe for more.